Good morning, everyone. Welcome to today's webinar, Exit Planning for Business Owners, Creating a Strategic Plan to Ensure a Profitable Transition to Retirement or Your Next Phase in Life. My name is Brianne, the administrator for this webinar, and I will be going over a few things before we begin. Gettry Marcus would like to thank everyone for attending what should be a most informative webinar. You have all been placed on mute for the duration of this webinar. As participants, we love to hear from you, so please type any questions you may have in the Q&A box, which you will find at the bottom of your screen. Your questions will be answered toward the end of the presentation. This webinar is being recorded and will be sent to you following the presentation. I would now like to introduce you to Lee Ferber. Lee is the partner in charge of Gettry Marcus's M&A Transaction Advisory Services and Healthcare Consulting Groups. He has been a partner with the firm since 1999. As a partner in charge of the firm's M&A Transaction Advisory Services Group, Lee works collaboratively with business owners and their management teams, advising in all phases of the sale of their business, from early stage planning through final transaction execution. Take it away, Lee.
Thanks, Brianne. And just in terms of administratively, Brianne, any questions will be in anyone on the call could just send to the chat, and we'll address them either during or towards the end of the presentation. So thanks everybody for joining. Good Thursday to everybody. So we have on the panel today Joe Milizio, who's the managing partner at Vishnick, McGovern, Milizio, and the exit and succession planning practice leader. Joe represents startup and established businesses, providing day-to-day general counsel and advice. He has a specific experience in various areas of transactional law with an emphasis on business transactions, including acquisitions, sales, entity and owner representation. He represents a wide range of businesses, including retailers, manufacturers, retail entities, healthcare providers, and other professional industries and organizations. We also have Anthony Citrillo. Anthony is a managing partner and founder of the NYBB group. He represents privately held companies seeking professional representation from an intermediary as they look to sell what is typically their largest asset, their family-owned and/or investor-owned business, and in many cases also real estate. Anthony represents private equity groups, individual entrepreneurs, and other financial sponsors with annual revenues from 5 to 50 million. So clearly you could see that myself and the two panelists have clearly been doing this for a while. A little clue. So they were selected because we've been dealing with business owners, whether it's family owners, private investors that have been together for many years, and we all have some real life experience with exactly what happens and the issues that are faced and addressed as you start planning for an exit. So we're going to make this very conversational. Again, if you have any questions, any comments, just send it to the chat, and we could address them as we go along or towards the end. So today's topic, exit planning for business owners, creating a strategic plan to ensure a profitable transition to retirement or your next life. Brianne, I just want to make sure everyone can see the slides.
Yep.
Great. So again, while many of us focus on retirement as a reason to have some type of plan or strategy to exit a business, there are a lot of other situations which we'll talk about, which may come about unexpectedly for a number of reasons in life, or opportunities that just present itself. So it's creating a strategic plan to ensure a profitable transition to retirement, or perhaps your next phase of life. So what is an exit plan? An exit plan is part of a broader strategic plan that moves the business toward achieving long-term goals for its stakeholders. An exit plan provides a roadmap for a smooth transition to retirement or another phase in a business owner's life. An exit plan details the actions necessary to sell or transition a business, taking all business stakeholders, finances, and operations into account. Joe or Anthony, I'll let you chime in here where you see you've had successes in these type of exit strategies and plans with good outcomes, where there have been failures, bumps in the road. Any thoughts you have?
Well, if you would, I don't know if this is the best way to start, but I have what I believe is the ultimate disaster scenario that I just actually finished working on. Our office had the matter for over 10 years in-house, and it involved an estate. It involved a business, and it involved a piece of real estate in Manhattan on the Lower East Side, what is now commonly referred to as the East Village. So we are dealing with a multi-use real estate parcel with a store on the first floor and apartments upstairs, with a fair market value of anywhere from $8 to $10 million. We are also dealing with, or we're dealing with, an estate. Let's call the decedent Bertha. Bertha and her husband in 1937 organized a New York corporation, and they did not elect at that point or at any point in the future subchapter S status, so it was a standard C corporation. And the certificate of incorporation back then indicated the potential shareholders who might come into the business. And it's interesting because it said potential shareholders as opposed to the specific shareholders. Just as an aside, certificates of incorporation do not provide for that any longer, so it becomes even more murky as far as owners of a corporation are concerned, and that's really what I'm getting to. After Bertha passed, the executor of the estate brought all of the business and other information to us, and we poured through it. And we saw that there were no stock certificates, there was no stock book, there were no records of any meetings of directors or officers or shareholders. There were no elections. There was nothing at all, including the fact that they never filed a tax return from day one. So we were left with the task of having to dispose of a very valuable asset without being able to show at all who owned the corporation which owned the asset. And there was really nothing that we could do. We searched for the people that were named in the certificate of incorporation, hired an outside third party to do a genealogy search as well. Nothing came up as far as any current names of people that were still surviving, etc. And it became a real problem in that the building itself was deteriorating to the extent that a sidewalk shed needed to be built around it for safety purposes. So there was definitely a liability issue. The beneficiaries of the estate, two children of Bertha, did not speak to each other, so it made it all that much more difficult to effectively handle the estate and its finances and just moving it along as far as administration is concerned. And bottom line is, after marketing the property for quite some time, we sold an interest in that the estate had in the corporation, if in fact that an interest existed. So instead of selling the shares of stock in the corporation that the decedent would have owned, we don't know that the decedent actually owned those shares. And what happened was we sold any interest that the decedent might have had. And as a result of that, the title company for the buyer took offense at us not selling real property or shares of stock, but nevertheless, that's all we could do. And the ultimate sale price was cut by more than 50% of the fair market value because we could not make the determination as to who owned the corporation.
Anthony,
That's a disaster in my head.
I would say so. Anthony.
We've had some successes, Lee. I think, the interesting part about the whole topic is, I'd say 5 years ago, very few people were even thinking about what they didn't really know. The two words, it was an oxymoron to them. It didn't really make sense. Exit plan, and I think we finally come to terms with it. And a lot of folks who had not thought about it, are realizing that probably 80% of their wealth is trapped in the business, and they really need to do something. Just statistically, people have to realize, why should they plan for an exit? I mean, with a population in the U.S. of over 300 million, they say about 25% of those folks are baby boomers. And out of those 25%, there's between 5 and 6 million who own businesses. And baby boomers who own businesses, 85% of them are probably going to exit in the next couple of years. There's going to be competition for your business. So that's one thing. But we've had success and we've had some failures. I mean, I don't know if it's a failure. Sometimes people come to us and say, hey, I need to talk about an exit plan. And I go, okay, let's talk about you and what your thoughts are and how you want to transfer the business. They go, no, I want to sell the company. So a lot of folks think that that's the only exit plan. But recently we had one where somebody was in the construction business, about a $10 million company, and came to us probably 2.5 years ago and started really thinking about selling the company. He was younger. And the key there is younger meaning he was still in his late 40s, right? And then he turned 50, I guess, during the transaction, actually. And came to us and said, hey, what do I need to do really to kind of, I want to extricate myself from the business. We looked at the business and we said, hey, one of the big problems you have is you're the business. A lot of people come to you for it. So over the course of the next couple of years, he hired a management team. He actually had handed off some of his responsibilities. He had no concentration of customers. He needed a much better financial situation. He didn't have really a good set of financial statements. He actually did that. Turns out 2.5 years later, he sold the business to an individual who knew about his industry. He was in the mobility space. And those folks now, believe it or not, are their exit strategy coming in. And that's the message, really. Have an exit strategy when you come into the business. Their exit strategy is to roll up similar companies and sell the company in 5 to 7 years. So I think there's a possibility. The other thing is I have my own exit strategy. Obviously, as you said, most of us on the call here, most of us here are maybe not the youngest of people in the audience. But fortunately, I have 2 younger partners. I figure I can't do this forever. And some people really need to really think out of the box about that. I guess, Lou, you find that even in the accounting profession, right?
Yeah, absolutely. We'll definitely get into that as we move through the presentation. But just at a very high level, really the key is deciding kind of where you want to be and what your plan is. And so when you talk about an exit plan, most businesses focus on a marketing strategy, operational strategies, financial strategies. They don't have an interplay with any type of exit plan. I had a recent situation with a family, 2 brothers and a sister who wanted to sell, and they were not on the same page in terms of what they each should get in terms of the final proceeds in the transaction, so on and so forth. We advised them, kind of get your internal house in place, and they rushed ahead, went to market. Long story short, when they found a buyer, the deal fell apart. Because they were just all over the place in terms of what they each wanted. The deal, they signed a letter of intent, the deal never moved forward, the buyer got nervous, the buyer was concerned that after the transaction, there could be lawsuits among the family. Long story short, they finally decided, let's take it off the market. Let's decide internally what we want to do. They amended their operating agreements. They kind of got their family dynamics in check. And it took about a year, and they eventually sold the business successfully. So the key is with an exit plan, you have to have a strategy. It could be part of your regular strategy that aligns with your other strategies in the business, but it's important. So I'm going to go to the next slide. I'm going to keep, we'll try to keep our responses at not a very technical level, which I think would be good just to keep the dialogue moving. And this is not necessarily a technical discussion. Joe, towards the end, will address some, trust and estate planning issues. But really, the goal in this presentation is to give you some food for thought in terms of how you could deal internally with what's going on in your business, whether it's family-owned business or an investor-owned business. So what is a strategic plan? It ensures business value is not diminished, makes the business more attractive to potential buyers, keeps the end game in view, making day-to-day decisions more strategic in nature. At the end of the day, whenever that day comes, whether it's a year, 2 years, or 10 years, you don't want to be in a situation where there's no planning. And when you're actually looking to sell and an investor comes in to make an offer on your business, you want to give yourself the best chance to get not only the highest purchase price, but also the best terms. So Anthony, I'll start with you as a transaction advisor who's basically the quarterback for potential sales of business and real estate. What are your thoughts regarding this type of plan?
I think it's critical, and I think you have to look at your business critically in order to make sure you are maximizing the value of it. Yeah, I think when we talk to people, like there's three kind of components. I think they have to look at their personal plan too. When they look at it and say, hey, what's my personal situation look like? They have to look at what their business looks like, and they have to look at what their whole financial picture looks like. And they have to be, they really need the assistance of their trusted advisors in terms of knowing what really is important and what does my business look like? We have so many clients with things like customer concentration, where they don't really know, how to kind of move that ball up the hill. We have so many clients who really don't prepare for, what happens to them personally. God forbid something happens to them, physically, or something happens to them where they can't perform. So I think those are important things to look at. You have to look at your business as if you were the buyer and say, hey, what would be attractive to me?
Joe, any thoughts?
Yeah, I obviously agree with Anthony, but in looking at my prior example from the last slide, the estate of Bertha could have received twice the purchase price. It could have doubled the amount that it actually received by simply having the corporate documents in place, the fundamental documents, that being stock certificates, resolutions of boards, of the board of directors, officers, and shareholders, a shareholders agreement among the owners of the corporation, whoever they were. Just those fundamental documents could have led to an ultimate sale at a much higher valuation. And the same thing holds true, I'm sure you see this, Lee, day in and day out, in that small business owners often don't have a good handle on their financial statements and their financial situation, in that they might charge their personal expenses, or some of their personal expenses, their automobiles, travel, things of that nature. And all of that needs to be looked at by their team, their accounting team, their attorneys, their business people, to make sure that everything is aligned so that you put the business in the most favorable light.
Absolutely. And we have some other webinars coming up where we address that in terms of what we call quality of earnings data books and getting your accounting and your financial reporting in better shape in advance of any potential transaction. So as Anthony touched on before, in terms of why a strategic plan, it protects business owners and family members when unexpected events occur and significant changes are necessary. And this could be due to illness or death of an owner or a key executive, a loss of a key customer, loss of a key employee. Without a clear exit plan, business owners risk limiting their future options. So business could be doing absolutely fantastic, and the unexpected happens. And then very often it falls on the investors who are not really active in the business in terms of managing the business, or worst case scenario on family members that have never been active in the business. And all of a sudden it becomes a fire sale. So we're going to get into some other topics, how to ensure, at least do your best to ensure that this won't happen. But these are issues that you face. And I'll just move on to two other kind of related slides. We talk about planned versus unplanned exits and why two strategies are needed. The involuntary exit strategy when things don't go as expected. So we just talked about one of them. You fall ill and are not able to work. Who will take the reins? Your business begins to fail financially, or you simply burn out and decide it's time to leave. What we're seeing post-pandemic, a lot of business owners are saying, you know what, I'm done. I wasn't planning on retiring for 10 years. I think financially I'm okay to retire as long as I could get something reasonable for my business on a sale. And I just don't want to deal with supply chain issues, with the staffing issues that most businesses are facing today. I'm tired, I'm burnt out, we've done really well, we've gotten through the pandemic. Now is the time I want to sell. So Anthony, I'm sure you're seeing this as
Yeah.
well. I know we have mutual clients
Sure.
that have been at this crossroad for the last 2 years, I would say.
Sure, and I think, Lee, burnout is probably pretty much number one on the list, and folks have to realize what their business looks like, and one of the big things that people look at is the team that you have associated with it. The one thing I wanted to add here too is, we've had a lot of cases where there are strategic buyers out there looking for a business, looking to purchase, someone out there's company, and they don't even realize that. So you really have to have the business ready for that possibility as well. They may come knocking on your door and saying, hey, listen, I want to purchase your company. There's a lot of activity, as you know, Lee, especially in the healthcare world, but on the private equity side, where companies are looking and saying, hey, you know what, we want to grow through acquisition. And they target certain companies. And if they're knocking on your door and you're not prepared both with your management team, you're not prepared with your financial statements, you're not prepared as if you knew you were going to leave the business, then you may not have, there may be that great opportunity for you to cash out, where somebody's going to give you maybe a higher multiple than maybe some other people would if you were actually marketing the business. So my message to folks is always be prepared. Don't think of it just in the event that you fall ill. We've unfortunately had the case where we've gotten called several times where the principal in a business has passed away. And if they pass away, in one case, it was a dentist. And think about everyone, think about it. If you're going to a dentist and it's whoever it happens to be, and the next time you go, you call and they say, listen, he's not there anymore, or she's not there anymore, but we have somebody else standing in. What would happen? The practice gets devalued immediately. And I think people have to look at that, look at it. It's an asset that you have. You got to protect that asset and make sure you cash out on that asset. You work your whole life for it. So that's my message to folks.
And in those professional situations, it's not like a surviving spouse or an executor of the estate can come in and sort of take over the business. It's a restriction in that obviously you have to be a licensed professional to operate the business. So it makes it that much more difficult, especially if it's a sole practice where somebody's operating on their own.
Yeah, I don't want to digress too much, but I have a current situation, which is, sometimes things just come about unexpectedly. A family business on Long Island. I won't mention anything specifically about them other than they're a distributor. And they looked out to the market and they found a company that's based in Japan that's looking for an entree into the US. And this family business, which has been around for probably 50 years now, very successful, created that opportunity. The family, well before they even took out to the market, they got their financial house in order. The family members all were in agreement what they wanted to do. They agreed to have one family member represent them in the transaction. And they started the process early. And when they finally identified this buyer, they didn't have to worry about family dynamics or financial issues. So again, everything is about planning and thinking about the future of the business like you would in any other area of your business. So in terms of options, a lot of them are obvious, but I'll mention a few of them. The owner can stay on. We have situations where the owner remains at the company as chair and delegates day-to-day responsibility to current management team. I had a pretty large urgent care practice that sold years ago. Basically 2 ER doctors that grew to about 10 locations. And one doctor was 70 or so, the other one was in his low 40s. One wanted a full exit, the other one wanted to stay on. So they knew that before the transaction, and that's the way the deal was structured. So there were no surprises. The older partner got a full buyout. The younger partner got a 50% buyout, and he stayed on to transition the practice. You could sell to family members, and we'll talk about this. And there are really crazy dynamics there when it comes to succession planning. You could sell to an unrelated third party. As Anthony said, there's tremendous interest out there in private equity. A lot of cash has been left on the side during the pandemic. And there are a lot of private equity investors that want to now look for good opportunities with private companies. You can sell to key employees or executives in management or employee buyout. You can have an ESOP, an employee stock ownership plan, as a possible option in the right circumstances. We've seen some great successes there, but it's a very unique type of opportunity if you have a strong management team. And then not as likely to take place, you could have a merger with a similar business, which is not very common. Usually it's a sale of assets or a sale of the equity in the business. We've had situations where you take the business public, an IPO. You just don't see that a lot. And the way the market is today, a lot of these potential IPOs are being put on hold. And the worst case scenario is another option is you close the business, liquidate. Hopefully that's not a situation. So Joe, you want to offer some thoughts on this?
Yeah, so I see that last unfortunate scenario or option more often than not, frequently with estate administration matters that we have in the office. The owner dies, as they say, at his desk, is still working hard, still trying to promote the business, build the business up, concentrate only on the day-to-day operations. And when he or she is no longer there, then everything falls apart. We've worked with surviving spouses who come into the business and try and take over, even if it's just from an account payable and account receivable administration, and they truly don't have any clue in so many situations. So I recommend fractional CFOs, people that will come in and attempt to at least put things in order. But you need that plan in place so that you don't end up with that negative liquidation or just closing the business and walking away.
So Lee, I think a couple of things that I thought here. There are so many owners who say, gee, I really want to take care of my employees. I'd like to see my employees run or buy the company. And depending on the size of the company, it may or may not be possible. Oftentimes, employees really are a W-2 folks and probably not entrepreneurial as much as the owner is. So in smaller companies, it doesn't work. We do see the liquidation process, somebody closing the business happens with smaller companies more than larger companies. Let's say under $5 million in revenue. And the third thing I see is years ago, there would be a lot more succession for the next generation and intergenerational transfer. I think statistically now we're probably under 25% where the second generation takes over, and maybe under 15% where the third generation takes over. I don't know if anybody knows of a fourth generation business. I know of a couple, but you don't see even the second generations. Two reasons, I think. One, the owner really doesn't want the second generation to take over. They want they want their kids to go and develop their own career and move in their own direction. And also, I think they realize that if that happens, sometimes that liquidity event doesn't happen too. It gets transferred to the next generation, and they don't end up with a full bag of cash in their pocket, so to speak.
Yeah, absolutely. And we've seen success with businesses which are usually, I would say, second generation, sometimes third generation, which, as you said, Anthony, there's no real succession, no family members that want to take on the business. And they will give up 10 to 20% of the purchase price to a key management. And these are people that have been in the company for 15, 20 years, who the owners really put a lot of faith in, and they're the ones that really drove the business. So you say to yourself, okay, well, on a $30 million purchase price, I'm going to give 10% of $3 million away. Well, first of all, it reduces your profit, reduces your gain from a tax standpoint, like $3 million. Secondarily, whoever's going to buy the company, now they know that there's a vested party. And that $3 million could be structured to be paid to the current management team over a 3-year period. So you provide continuity to the business. So if the founder of the business leaves, management stays on, not only because they're getting a chunk of money up front, but as long as they stay on and transition the company to the new buyers, there's more money to come over the next 2 to 3 years. So all these things have to be discussed, kind of flushed out. And you really want to have objective conversations with those who are outside the business, whether it's people like the 3 of us on the screen, your own financial advisors, your own personal accountants. So again, the key takeaway here is you have options. You just need to try to solidify what those options are.
Lee, I had one other thing, almost in every case, I think, where we're dealing with, especially the private equity purchaser, the financial buyer there, in almost every case, they want the existing owner to retain some kind of equity. And if they don't retain some equity, they want them to have some kind of note that they have some kind of skin in the game. And we see that almost in every case. So it could be a good thing for the owner who's going to stay on perhaps and help run the company. But I think it's part of the mandate that we see as somebody should really kind of expect that to be the case. So even though if they want to sell 100% of the company, they may still end up with 20% of it and sell 80% at some point.
Yeah, and we see it a lot, especially post-pandemic, where there's been a lot of business disruption where we call it earnouts, where in many cases they get a significant chunk of money up front, and then they get the balance over a period of time. That's just the way a deal is negotiated and structured. Like Anthony, you said, there is a possibility if it maybe isn't the best possible, the company is not really ready to sell or what have you. There may be an area where you can't sell a majority interest. You may sell a minority interest. But I think overall, in pretty much all the cases we see, as long as the business is ready to sell, there is a good chance you're going to sell a majority up front and perhaps get some balance of the purchase price over some period of time. Moving on to actually creating a strategic exit plan. I think Anthony spoke about this a little bit earlier. You really need to assess your finances, both personally and professionally, to better understand your post-retirement financial needs, really to help you seek out and negotiate an offer that aligns with your financial needs. So there are some business owners that, between money in the 401k and other investments, they don't need a huge chunk of money on a sale to live their life in retirement or post-exit the way they want to live it. But this is where you need to kind of know where you want to go, right? It's helpful so you could know what type of valuation are you looking at for your business before the business sells. There's no guarantee you'll get that valuation, but it helps to have some idea where you'd like to end up. Consider your options. And this is more not financial. This is more just reality. What happens? How do you envision your life after you exit? What are your interests? What are your hobbies? Do you want to stay on in some capacity? Does your business still fit into your lifestyle post-exit? For a lot of baby boomers, myself included, and I'm not 100% proud of it, my business, my work has become just a big part of my life. And to extricate from that business is going to be tough. But when the time comes, I want to at least know in my mind, what I'm looking to do. So I'll just go to one more slide, then we'll just open this up to some conversation. I'll stick with this. I'll stick with this slide for now. Anthony, any thoughts?
Well, look, I think you got to realize too, Lee, your case, our case, you want to be able to control that process and know when that's going to happen. Talk about, and you really have to really assess where you're at. My first step with folks a lot of times is know what the business is worth. Hire a great company like, Gettry does a lot of great valuation work, and this isn't just a promotion for you, but that they've done it for years. I think you got to look at that and say, hey, what's my company worth? And in that process, you got to look and say, hey, am I living vicariously through the business? What am I writing off through the business? And how is it going to affect my lifestyle post-business if I'm not able to kind of take those expenses through the business? I think that's kind of an important factor, especially in smaller business. You see it in oftentimes almost every size business. And most of the owners, believe it or not, are surprised at what the level of compensation plus benefits plus other things that they take out of the business look like.
And Joe, I know you and your firm do a lot of trust and estate planning. So I'm sure you come across this every day.
Yeah, and there's a definite dichotomy between, okay, how do we maximize the sale price and cover what we need to actively retire versus how do we minimize our estate tax potential consequences and pass wealth on to family members to the greatest degree possible. So an exit strategy is perfect for working that situation out because, number one, I often work with people who think they're going to sell at $10 million and they're going to live on that $10 million, but they don't understand or forget perhaps that there's a tax consequence associated with that. And after their professional team actually calculates the tax consequences, they say, I might as well stay in the business and continue to operate it. Well, yeah, certainly that's an option. And we've already discussed staying on as perhaps a CFO or something along those lines. But you also want to look at your future and plan accordingly for your future with your team now.
Yeah, and with respect to taxes, and this will be discussed in future presentations, we always look at when it comes time to sell or you get some idea of the valuation. We call it like a stay versus sell analysis. If you live in New York and if you live in New York City, your effective tax rate is probably 45% on regular income, W-2 income from a partnership, from an S Corp. When you sell a business, you get the benefit for the most part, but not 100% capital gain rates. And that arbitrage is roughly 15 to 20%. So that's where when Anthony and Joe are talking about, you do a valuation, what does that valuation mean after you tax affect it? So those are things you're better off understanding before you start the whole process of going out to market and looking for opportunities to sell, just to know up front, just to know, what you're looking for and at what point you think it makes sense from a post-tax transaction. What are your net proceeds from a transaction? So I'm
And
going to move
Anthony
on.
also mentioned before that he sees a lot of sellers retaining equity either in the entity that's sold or in a new entity that perhaps a purchaser is rolling into a larger company. And there are methods, as you know, Lee, to get around having a tax consequence with respect to some of that equity, an F-reorg, to quote a provision of the Internal Revenue Code as an example.
Yeah, and those rollover interests, especially when you're being acquired by a larger larger company that has a separate legal entity set up to acquire assets, you can roll over an interest, and as you said, Joe, that reduces your gain, and also you get a chance. Now this larger entity, as they continue to acquire businesses, you have a second, what we call a second bite of the apple to get additional sales proceeds at a later date.
Right.
So continuing with creating a strategic exit plan, this is, a sensitive area. And this is most of the deals that we have, they're pretty confidential. They don't want their key employees to know about the transaction, at least early on. But at some point, it's important to bring those key stakeholders and investors into the loop. So you're talking about discussing with key stakeholders and/or investors at some point, and there's a way to do it in a way to keep the staff on so they don't panic and leave. Once an exit plan is in place, share with your employees and be prepared to answer questions. Be transparent and understanding of their concerns. One thing I could tell you is when staff who are younger than the owners look at you, they're thinking about what happens. In 10 years, if you sell, where am I? What happens if, God forbid, you don't make it 10 years, you fall ill? What happens? So there's a way to present it where you can give actual key employees a real comfort level that there's a plan. And if, God forbid, you as the founder are no longer involved in the business, they're going to still, the business will continue. The business will move on. Start handing over greater responsibilities to key employees. Detailed roles for key employees and stakeholders. So I'll give either of you the opportunity to give some thoughts on this as well.
Yeah, Lee, what's interesting is folks have to realize that we are in an environment where, talent is really very important. And I think, the retention of that talent is part of the value of your company. So you have to, number one, treat them properly in terms of, what their responsibilities are, what their compensation is, and two, make sure that you do whatever you need to do to retain their services. Sometimes it's a stay agreement. Joe can talk about some of the legal possibilities there. Sometimes it's a bonus in place. When we do some transactions, some of the internal people, especially the CFO or the controllers, you really need their assistance in order to gather the information that's necessary to get the transaction done. And sometimes the whispering could be dangerous if you really don't handle it properly. But remember, talent, just like you talked about previously, the supply chain being a problem, talent being a problem, we have more diligence going on with employees now in order to understand who the employee is, how long they've been with the company, what their total compensation package is, how that relates to the marketplace, what their position is, maybe what their plans are. Some of these things are not revealed, but there is a very deep dive done with the staff now.
And I could tell you from the standpoint of keeping those and retaining those key employees, business owners generally are fairly, uncomfortable or remiss in giving any equity to those key employees. But you could have, phantom equity, where in an employment agreement, you could, give them 5% of whatever the sales price is. So using that example, even if it's 5 years down the road, you sell the business for $20 million at 5%, there's $1 million that would end up in a key employee's pocket. Not to mention that they have, the continuing earnings as an employee of the business over the next few years, 5 years, until the business sells. So there are ways to do this. Start getting your staff on board, and it kind of motivates them. They say, wow, okay, there's this nice chunk of money I could potentially get at the end of the day. It really provides an incentive to them and also helps with an exit strategy. Joe, your thoughts?
Yeah, I believe employment agreements are key in most situations, especially for businesses that are held by one or two owners, and your key employees play an active role in the operation and success of the business. So we need to be a little bit careful these days because there is a lot going on with enforceability of non-competes and things of that nature. But nevertheless, an employment agreement that has an employee with a certain amount of comfort going forward and knowing that the business might be sold acts for a lot for the success of the business for the future.
So we'll move on. Again, talking about creating a strategic exit plan. And we talked about this previously, but understand the true market value of your business. Have a valuation prepared, prepare a quality of earnings analysis, which we'll be talking about on future webinars. And this is typically the main financial document that's used in due diligence when you actually are have an offer and you've agreed upon a purchase price and you're going through a 90-day period for the buyer to come in and really kick the tires. Start paying down debt if possible. Most transactions are cash-free, debt-free. You keep the cash that you've accumulated prior to the sale date, but any debt you have on the books, bank debt, term loans, lines of credit have to get paid off at closing or before. So consider start paying down debt. It could help with the valuation. As I think Anthony mentioned, or Joe, I'm not sure, consider hiring a part-time CFO or fractional CFO before putting the business on the market. So we sometimes serve that role, but sometimes it's just not feasible. And a larger organization or company will need to bring in somebody at a higher level to help them internally get the financials in order. Bring in outside expertise, financial advisor, attorney, accountant, transaction advisor. I'm not promoting ourselves on this call, but I will. The fact that you have trusted people with certain expertise, M&A is a very specific area, and having people, whoever they may be, whether it's any of us or any other advisors that have been through this, they're going to help you navigate the pitfalls. So this is all part of developing that exit plan, a real strategy. Anthony?
Well, yeah, I have one comment. I mean, I know you're going to talk about quality of earnings in a future webinar, but it's an analysis that's done typically by the buyer to determine, the actual, the earnings that are verifiable and earnings that they're going to pay on. We recommend the sellers actually, and that's probably what you meant here, really get their own quality of earnings done even prior to. You don't want to be surprised by what somebody finds when they do a quality of earnings. It's really I think it's a good investment. It's probably a few bucks they have to pay, but they got to really prepare that way. And I think the last thing I have to say is there has to be someone who knows your whole picture. When you talk about outside expertise, a lot of times the financial advisor has a better picture of what your entire life looks like, what your value looks like, what your financial picture looks like, and maybe they can probably say, hey, make some sense about what your exit will look like from a financial standpoint. Hopefully it's one of those people.
Yeah, and the reason why we meaning the sellers, when we represent sellers, like to do the quality of earnings, we kind of set the narrative. And it's all based on historical, credible financial information. So instead of the buyer coming in and making an initial offer based on their view of the business, we set the narrative. They don't have to agree, but it's just the idea of who kind of calls the shots initially and sets the narrative. Joe,
Absolutely.
any thoughts?
Yeah, just one piece of advice. Make sure that your team has the expertise to take you through a transaction. I often deal with clients who say, I've had my accountant, just as an example, for many, many years, and I trust him or her with everything around my business. And that's great because the accountant will, in fact, be able to incorporate a lot of the information that they know into the preparation of the strategic plan. But you also want a firm like Gettry to be there to give their expertise in the M&A world, to give their expertise that an accountant who's handling your business on a daily basis might not have. And obviously it's the same with an attorney as well.
Yeah, with attorneys, more times than not, for even a really, pretty significant business that's been around forever, it's the owner's brother-in-law who's a real estate attorney who prepares all the agreements. And not to say they're not 100% competent attorneys, but it's like going to a specialist in healthcare. You're not going to go to a gastroenterologist when you have an ENT issue. So, and if you're with a bigger firm, they may have, a good M&A attorney on staff. If you're with a larger CPA firm, they may have a M&A accountants on staff who have experience in this area. So again, it's just having a good team in place to advise you so you avoid any pitfalls as a transaction moves forward. So now the fun part of the presentation for all of you who are in family businesses. And to a certain extent, this also correlates to a business with investors, 3 or 4 partners, you've been together forever, you trust each other, but you all have different views on the business. So these are some of the strategic elements of a family-owned business succession plan. Communicate ownership intentions, share strategic exit plan with family members, nurture career paths for key employees, address potential nepotism, reverse nepotism, and entitlement. I'll give you one crazy example. We had a client that was in the wedding dress business. It was a brother and sister that owned the business. And the brother, who was probably close to 70 at the time, was one of the partners, and his sister gifted the business to his nephew. So they each had 50% ownership. Long story short, when they would go to Asia for their regular business meetings, the uncle would sit in first class. The nephew would sit in economy in the back of the plane. And when I met with both of them individually, they cursed each other out. So, there's, you talk about nepotism, reverse nepotism, where some owners, fathers, mothers may not want to give to certain children. They just may have it out for a certain son or daughter. So nepotism works both ways. You may want to direct benefits to a sale to certain family members, but you may also feel, certain family members are not entitled to it, but yet they may have an equity interest. So you have to address those issues. Start building accountability and review systems, articulate compensation strategy, begin the leadership transition, and engage advisors to assist with succession planning. So again, you want objective advice. You don't want family members or those that are too close to the business to be maybe too subjective or get into the psychology of it too much. You want to get some objective advice to deal with family dynamics. Joe, I'll let you start off on this one. I know you deal with it a lot in terms of trust and estate work.
Yeah, and especially in the leadership transition area, dealing both with employees and other family members. So I often see the successor coming up and not starting in the mailroom, as they used to say. I'm not even sure if they have mailrooms anymore in most businesses, but not starting at the bottom and working their way up through the business, instead sort of taking a middle management role. And employees are often confused as to who they should be reporting to. Do I report to the actual owner who I've traditionally reported to? Do I report to the successor or the potential successor? And there's confusion there. So it's a matter of providing the information to your employees and to your family members as well, because I can't tell you how many estate administrations come through our office with the children not having any clue as to how mom and dad set up the plan for succession for their business. And to tell you that it leads to arguments among siblings, it often leads to lifelong arguments where siblings don't want to deal with each other any longer because they think mom or dad gave more or less to them or to their siblings.
Yeah, and look, I think sometimes it's when you look at leadership transition, sometimes it's a revelation to the owner that there's nobody to transition it to, or maybe it's not the obvious person. And sometimes you have to look outside of the organization for that. And there's oftentimes we have so many family disputes that it could upend the value of the business and upend the sale because the whole process really becomes less than smooth, let's call it. So I think you really have to be on the same page with those folks. We've oftentimes had a situation where husband's running the business and the wife's been after him to retire for years. All of a sudden he retires and he really doesn't know what to do with himself. And I think it's really an issue there too.
What I've seen in a lot of situations is a parent that's running the business is concerned about telling one of their children that they're really not going to be involved in the business going forward. and they just don't want to address it. But typically what happens is all the siblings kind of know in their own way who the productive children in the business are. So once the business owner is kind of scripted and kind of knows how to address it, sometimes it's a relief to that son or daughter in the business who's been struggling for years. They've never really been able to step up. They wanted to do something else. And so you really accomplish two things. One is you're able to build a true leadership team with the children in the business, and also help that child who maybe just isn't really cut out for the business, and let them know that they'll be taken care of financially. So sometimes things will surprise you like that. So but you have to really go through the process. So we'll end on this slide without too much technicality. But Joe, you could talk a little bit about gifting, trust, and estate planning in terms of how we can minimize taxes and what have you.
So here's where everything becomes counterintuitive, because with a family transfer and estate planning, which is an integral part of business succession planning, what you want to do is come up with the lowest defensible value that you can possibly come up with and pass that value on by saving estate and gift taxes for the grantors or the transferors, as well as to build up the business for the younger generation coming in. So there are discounts that can be given by transferring minority interests, by transferring interests in the business that don't have any voting control or voting power. And Leah, I'm sure you've worked up those types of discounts often enough to say, okay, this business might be worth X if we were selling it 100% of it as a whole. But if we're only selling my minority interests, those minority interests are valued much less. And the use of trust is such a beneficial mechanism because you can place assets, including business assets, into a trust at a discount, but somebody else is still controlling those business assets, be it the trustee that you appoint to supervise the trust. And it protects the beneficiary from creditors as well, in that a creditor can't reach an asset that's in a trust for the benefit of someone, and protects in the situation of a divorce going forward, things along those lines. But most importantly, you're trying to reduce the value of your business when you're passing it on to your family. And if you need replacement income, there are other mechanisms for replacing that income, such as consulting fees, payments for expenses, things of that nature.
So I'll add one thing to that, and then we'll just give our closing statements. But with respect to valuing a business, the time to do it is well before you have an offer, because if the valuation and the filing with the IRS ends up with an audit of the IRS, and they could see that you already had an offer on the table for $20 million, and the value that you assigned on gifting the interest was $1 million, you're kind of stuck. So the time to do it is early on. It's a tough thing psychologically to do. It's kind of philosophical, but nonetheless, if you're going to do it, sooner than later. So I would just say if each of you want to just give a quick 30 seconds, we'll wrap it up. We're pretty much, we're about 2 minutes after the hour. Joe, you want to start off, then Anthony?
Sure. My advice would be to put your team together. As you said, Lee, do it early, but put your team together, ask a lot of questions, because let's say in the standard M&A transaction, most people are not familiar with the terms and the methodologies that are used, and people are often surprised that they don't receive the value that they thought they were going to receive due to complications with respect to calculating working capital, for instance, which is done post-closing. With respect to earnouts that are calculated differently from income prior to closing and after closing, so that the earnout potential is that much less. So make sure you know what you're doing, make sure you listen to your advisors, and make sure if you're an advisor that you cover every single aspect of whatever the purchase agreement is, because you don't want to have your client responsible or liable for anything post-closing.
So Lee, I have two very quick things. One, since most business owners have a majority, their largest asset oftentimes is their business. So failing to plan for that largest asset is typically would be something that would probably not going to benefit you in the long run. And the second thing is, from a personal standpoint, a majority of folks who, after they leave the business, really are just not satisfied with what their life looks like afterwards. So it's real important from a psychological standpoint, and as well as an economic standpoint, to really start that planning early and kind of get your arms around what the business is looking like and what you're looking like.
Yeah, and to everyone's points that they made in this call, all of us as advisors recognize that this is a real emotional decision, psychological decision. We don't take it lightly, but at the same time, you know, we're strong believers in planning, and planning, like anything you do in life, kind of reduces the anxiety associated with it. So that would be my takeaway. You know, plan, start having conversations. Rome wasn't built in a day. An exit plan wasn't built in a day. But when you start having these conversations objectively with people who are not vested parties in the business, all of a sudden you can look at it a little more clearly and a little more objectively. So Brianna, I'll let you wrap it up, but everyone will be getting a recording of this. You'll have all our contact information. Probably the best way to reach us these days is just send us an email and go from there. Brianna, anything you want to add?
Nope, that's it.
Okay, listen, I thank everybody. Thank you, panelists, and have a great day and a great end of the week.
Enjoy.
Take care.